This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
G'day everyone and welcome back to another podcast with Shane and Deanna. This week there's a whole bunch of things to talk about because a lot has been happening in relation to the Middle East. Tariffs still going, and of course in Australia we've seen some softer GDP numbers a couple of weeks back. Obviously ongoing inclinations by the Reserve Bank to cut interest rates. And the good news is we're seeing the Australian government talk more about boosting productivity. So Deanna, welcome back.
Thanks, Shane. Good to be back.
So how do you interpret the last month? It's sort of been okay for markets, but you've got all these things going on in the background. There's a long worry list.
And there always is, I guess, in the last few months. I mean, the economic data in the last few weeks hasn't actually been too bad. In the US, in Australia, we had that poorer March quarter growth figures, but it's really been more on the political side that we've seen more news, like the ICE raids in the US and the protests in LA, the end of the bromance between Elon Musk and Trump, although they sort of
so
got
when
back
the ICE
together a
raids
bit.
and the sending in the National Guard, wasn't that just to distract from the ending of the bromance and the assertion that Trump is in the Epstein files?
Oh, potentially. I mean, if you're a
what's better
conspiracy
way,
theorist.
pick a fight with California.
And then the passage of OBBA, One Big Beautiful Bill Act in the House.
I thought that was the big what is it? The bunker busting bomb. Isn't that BBB?
Well, that's
budget?
what it is now.
That's what it is now.
Yeah.
One big bunker busting bomb. Anyway.
So a lot of political noise in the last few weeks, but markets have looked through it and have just continued to rally. I mean, we have seen some short-term falls, I guess, 1 day or 2 day falls, but overall it's been pretty calm amongst what has still been quite a chaotic administration and still this continued cloud of uncertainty.
Yeah. It's almost as if the markets are just sort of thinking, well...
They're immune to all the noise now.
Yeah, there's all this noise. Maybe they've been listening to me too much, saying turn down the noise, and they are. But I guess you could also argue, back to that first point you made, that economic data hasn't been too bad. Like in the US, the economy hasn't gone into recession. Profit numbers, at least we haven't got data for the current quarter, but in the March quarter were pretty good. Inflation numbers, which we thought might have been picking up by now, are still fairly soft.
I mean, why hasn't the inflation data risen despite tariffs? We've got the May inflation figures now, and the import price data in the US doesn't actually include customs duties, which would be the tariffs. But even then, we haven't actually seen a big change in pricing behaviours from either business or consumer. So does this mean that tariffs don't actually impact inflation, which is what Trump would say?
Maybe Trump's going to claim victory here. My inclination is to think that it's just lags. That the corporate sector in America bought up big ahead of the tariffs and they're still running down their inventory. Well, they've got inventory with lower prices and the tariff impact is still out there. So I could sort of understand why the Fed's still a bit wary about things. Normally, if you got things the way they are now in the US with inflation sort of heading down, I think the last two core CPIs, where they strip out energy and food, have been around 0.1%, 0.1%, 0.2% a month. You're sort of around the levels that you would think were consistent with the 2% inflation target. Normally with that, the Fed would be cutting interest rates by now, but I kind of think they're still nervous about tariff impact still showing up, and that's why they're a bit reluctant. At the same time, they're thinking, well, we've still only got 4.2% unemployment, so there's no urgency for us to act, even though Trump keeps yelling at us.
And now, of course, we've also had a flare-up in tensions in the Middle East, which sort of causes even more chaos into markets, with Israel firing missiles into Iran and then Iran now retaliating. And it's been a few days of this conflict and Trump, the US sort of seems to be involved, but from far away, and sort of looks like this is going to continue for at least another few more weeks.
Mm. When the news came along there, I thought, oh, here we go again. Every so often there's some flare-up in the Middle East.
This one seems to be a bit worse than usual.
Yeah, it does. Yeah, I think it's partly because Israel is determined to go after Iran's nuclear capabilities. And Iran probably looked at Colonel Gaddafi and Saddam Hussein and what happened to them, just like North Korea does. Well, if we want to stay around for a long time, we need nuclear weapons that'll protect us. But then Israel thinks, well, you guys have been talking about wiping us off the map for the last 40 years. So if you get nuclear weapons, you'll probably wipe us off the map. So we've got to get rid of your nuclear weapons. And they now think there's a window there. I mean, if you go back a week or so ago, it wasn't clear this was going to happen. Trump was still saying the talks were proceeding and going smoothly, but it looks kind of like that they did give Iran 60 days. They hadn't gotten anywhere, and then Israel decided to take matters into their own hands. And now that they've been successful in, if you call it that, in getting control of the airspace over Iran, they're thinking, well, we might as well finish the job off. I mean, that seems to be what's happening. And of course, Trump is kind of maybe thinking maybe you should go along with that. I mean, this could change by the time anyone's listening to this, but it's true that this one seems more serious than the ones last year, where there'd be an exchange of missiles and then it'd soon be forgotten about, and no one crossed red lines that took the crisis any further.
And it also, the other missiles seem to be more targeted to infrastructure in the economy, whereas there are more civilian deaths, arguably, this time round across both sides.
Yeah.
They are still trying to target, I think, more of the infrastructure and the nuclear facilities and the nuclear scientists in Iran. But what also worries me is more of that indirect US involvement, or I guess giving Israel the green light. So if we have the US involved in the conflict, people are getting concerned that we could be heading into World War III. Although markets, again, don't really care about it.
What you were saying, loss of life is horrible, and it must be horrible living in those parts of the world. I mean, generally, given this threat hanging over you all the time. So that side is horrible. But markets don't think about that. The markets are just thinking, well, is there going to be a disruption to oil supplies? That's the only concern here.
But if we were to go into a broader conflict, I mean, with the Western world, including the US, then markets, I guess, should be pricing in a high risk premium for that. Share markets only fallen by about 1% on the news of the conflict.
Yeah, it's I think it fell 1%, then almost rallied 1%. Now it's back again, and oil prices out of interest have just gone back to where they were at the start of the year, which you could argue was all a non-event.
So
in the great scheme of things.
So why is this conflict important for oil prices?
Well, it's important because there's a thing called the Persian Gulf. Down one side is Iran, the other side is Saudi Arabia and UAE and Qatar, and then you go around and it becomes the Gulf of Oman. But the little bit in between is called the Strait of Hormuz, and it's quite conceivable that Iran could attack shipping.
And Iran controls that?
It doesn't control it, but it can fire missiles at ships going through it, much like the Houthis can fire missiles at ships going into the Red Sea. And the problem is that 20% of global oil consumption flows through that strait on a daily basis. It's about 30% of LNG or gas coming from Qatar mainly goes through that strait. And so if they start disrupting shipping, then obviously that has a huge impact, and that's why oil prices could go so much higher. Like at present, I mean, my rough calculation is that from the start of the month to now, and it moves around quite a bit, we're up around $12 a barrel, give or take. And that, roughly speaking, each $1 a barrel change US translates to about 1 cent a litre in Australian petrol prices. So that's why I've sort of made some reference to the petrol price potentially going up 12 cents a litre. But in the great scheme of things, it's a small move. You know, the oil price is just back to where it was at the start of the year. A big move, if you get a disruption to 20% of world oil supplies going through that strait, would see prices push well above $100 a barrel, you know, conceivably up to $150 a barrel. Back in 1973, the oil embargo of 1973, the OPEC embargo, that saw oil prices go up threefold from almost $3 to fourfold, $3 to $12. And in 1979, in the Iranian Revolution, which took Iranian production out of the system, they went up threefold, up to around $40. So that they were much bigger events. But obviously, if you get a supply disruption this time around, that's where you get the hit to oil supplies, boost to inflation globally, and that's what politicians and others are worried about. And that's what share markets are sort of concerned about. But the share markets are kind of thinking, well, that's such a bad thing. Does either side really want to go that far? Israel is constrained because they have to rely on the US for support. Trump doesn't want to see high oil prices. He was elected on the basis of no more forever wars in the Middle East. Iran faces a existential threat to its regime if it keeps pushing down this line. If it attacks oil flowing through the Strait, then the US is going to come down hard on it. So that's why I think markets think it's going to be limited, but you don't know precisely. And as you implied, the US could still get involved. And if the US gets involved, then markets will then start, I think, to get a lot more nervous about things.
So the risk for oil prices is obviously to the upside from here.
So it's to the upside. But the other context is that historically these things have happened a lot in the Middle East. You go through a scare, prices go up, and then a month or two or whatever it is later, they settle down. And in fact, you've updated some analysis on that. I mean, you put this into a context of what we call geopolitical events. And you've got a table in your latest Econosites, which actually looks at that, going back to World War II.
Yeah, so we looked at a bunch of different events that had some of the largest short-term impacts on markets around geopolitics. And with a lot of them, of course, markets initially fell on the news. It might take a few days or even a few months for markets to bottom on that, because a lot of the time, sometimes with conflict, especially with things like World War I or World War II, it's not just something that happens in one day. It happens over a period of time. So markets can initially start pricing in the risk and then can continue falling and then go up and then can fall even further. So we found that across all of those events, markets generally fell by about 8% from peak to trough. But then 12 months later, share markets were usually up again, on average by about 14 or 15%. So yes, these geopolitical risks are a short-term threat to markets, but over the longer run,
it's more of an opportunity.
It is, really. I mean, not all the. I guess it also depends what else is going on at the time. If we get into a recession in 12 months' time, maybe markets are not going to be up. But there's geopolitical events.
Because some of them, like 9/11, 12 months' time, you're still down because you're at the tail end of the tech wreck, and there's been a few others like that.
Yeah.
But most of the time, it's up.
Markets tend to recover over the long term, or not to price in these geopolitical risks for the long term. So as an investor, you can't really do anything now. It's too late to. It's definitely not a good time to start selling now, unless that your view is that markets are going to come crashing down. But generally, if we've seen a fall in share markets due to geopolitical risks, it's not a good time to sell at the bottom. But in terms of how the central banks would be thinking about these risks, I mean, they would probably just look through some of the short-term inflationary upside risks if we did see an increase to oil prices, wouldn't they?
Look, I think they would. I think, if you look at it, yes, you do get a boost to inflation. I did a very rough calculation, very, very rough. I think a $12 a litre rise, which only just takes us back to where we were a few months ago for petrol prices, but go up 12 cents a litre, not $12, 12 cents a litre, that's about 6.5%. And I think that translates to about a 0.2% boost to inflation. It's not that much.
I was surprised that it wasn't actually 0.3%, because usually...
That's the normal response economists give to all events, 0.3. Yes, yeah, that's true. You shouldn't say that it's on the podcast. People might start to work out our secrets, that 0.3 is always the answer. Or maybe I decided I'll use 0.2 rather than 0.3 because I know you'll say, here we go again with 0.3. But in any case, it's neither here nor there in the great scheme of things. And the RBA would say, well, we're just going to focus on the underlying trim mean measure, as they've done with electricity rebates when it was working the other way. Of course, if you get a bigger rise, like oil prices go up $40 a barrel and petrol prices go up 40 cents a litre or something, then I guess there's a bigger issue for the RBA. But I kind of think that they would still look through it. They would probably say that that's also a tax on consumer spending. People have less money to spend in the local economy, which could mean downwards pressure on broader prices. So you get a flow-on effect to prices that require transport, because transport costs go up, but that's relatively modest. And you also get an increase in the price of plastics, which goes into lots of things. But more generally, people would have less purchasing power because they're going to spend more to fill up the car, and therefore they spend less, which could act as a downward pressure on prices. So net, I think it probably wouldn't change the destination for interest rates ultimately.
But we have changed our view on the RBA.
Not on the back of the...
Not on the back of this.
Not on the oil thing. That was prior. That was to the GDP numbers.
Yeah. Yeah, so after the GDP data, which was pretty weak for the March quarter, and more specifically, I guess the components were soft. We haven't seen much of a recovery in the consumer. We've seen another negative quarter of per capita GDP growth. The productivity numbers are still horrible. And the RBA also now sounds a bit more dovish, like it wants to cut rates by more. It's a bit more concerned about the domestic economy. It also is obviously concerned about what's going on globally, but they did reduce their domestic growth forecasts moderately in their last forecasting round. So we now expect a 25 basis point cut in July, in August, November, and in February of next year. So another 4 rate cuts
So
from
it'll take
here.
us to 2.85.
That's right. So it looks like our cash rate will be below what we think the Fed will eventually cut to, which I guess makes sense because we never took rates as high as the US.
Yeah. I mean, it seems a bit gloomy. I mean, I think I thought was kind of gloomy was the private sector was still weak, and the public sector looks like there's signs of a slowdown there. And I saw some labour market stats the other day which showed similar sort of thing. And that's a bit of a concern that you've still got a weak private sector at a time when the public sector is finally slowing. And we've all been saying, well, we need to slow down the public sector because it's taking resources away from the private sector. But it sort of leaves the Reserve Bank in a difficult position because they want growth to pick up. It did look like it was in the December quarter, and now it seems to have slowed down again. And with all this stuff about tariffs and the Middle East, and that affects people's confidence, I mean, to my way of thinking, the chance of a July cut is as high as it was before the situation with Iran and Israel. I think the money markets are about 85% probability on that.
I mean, there's also reasons to be optimistic, though, especially on the consumer here, because we have already had rate cuts, we've had tax cuts, and we have lower inflation. So if anything,
I agree.
If anything, the outlook for the consumer is actually a bit better in the next 12 months.
Yeah. So things should pick up. It's just a matter of when. So far, they seem to be saving. I mean, there's also some light at the end of the tunnel, perhaps. I mean, a lot of this stuff sounds gloomy, and this is the nature of the world that you spend all your time talking about the threats. And then, of course, the share markets keep going up anyway. Like I have that favourite chart, the wall of worry, that if you look back through history, it just seems like a lot of worrying events, and share markets tend to drift higher anyway because you've still got innovation going on. The overall economic environment is not disastrous. You've got prospects for rate cuts. And then in Australia, on a longer term horizon, we've finally got the government admitting there's an issue with productivity, which I thought was a good thing. The Treasurer, straight after the election, was saying that productivity has to be a key focus in the next term. We've got a couple of ministers, the Housing Minister and the Minister for Productivity, saying that we need to deregulate.
There's a Minister for Productivity?
I think there is, yeah. I think there is. I think it's his assistant. I could be wrong. It could be assistant treasurer, but he has a title around productivity. And the housing minister actually started, that chart Meeboo has put together a few times, showing how long it takes to build a house or a unit in Australia, which is almost double what it was 10 years ago. And she sort of referred to that, how much longer it takes to build these things, to do these things, and referred to the need to deregulate to make it easier for developers to get their projects underway and done. So I thought that was fairly positive. And now we've got the Treasurer even saying the tax reform is on the agenda.
But how do we know that the productivity decline is not just because people are getting lazier?
Maybe, but I don't think people are getting lazier.
It's hard to know. It'd be a good index.
Yeah, but how are you going to measure that?
I don't know.
Oh, that's a hard one. Like, I mean, most of the evidence suggests Australians work pretty hard. And if anything, if I think back to...
If I think about my local area on a Friday, everyone seems to be out and about these days after the pandemic. It never used to be like that. People aren't in the office. They're at the beach. They're catching up at cafes. I think maybe...
So what time did you go to bed last night?
After midnight, because I was
working.
working.
What were you doing? You're working. That's right. I mean, it's the way people do stuff has changed.
Yeah, but I'm not at the beach on Fridays. I'm updating your charts.
Okay. Yeah, I know, but still, you might have swapped some things around. You maybe took your daughter for a walk or something, or your kids for a walk or something. You swap things around. Like I find I've done that. You work through the night because you can actually be productive then. Like I was working Monday night, but I might have gone to the gym in the middle of Monday. No, that's right, I went to the city. Monday afternoon I went to the gym. So you sort of swap things around, and that may be what we're seeing here, that it looks like people are not working more, they're down the beach more or they're in the cafes more. But I have a feeling that people have swapped their work habits around and are working a lot more flexibly.
It's hard to measure, but it would be interesting to see.
It would be interesting to see. But my theory on it is, the trouble is I started when Hawke and Keating were around, and so they become my heroes. And they did all these things that opened the economy up and sped it up and made it more productive. So it wasn't that we necessarily worked more, but we worked more productively. And those things have been lacking in the last 20 years almost. I mean, the last major reform was the GST, and then there was some backsliding on some reforms, starting with the Rudd government. I mean, they weren't too bad, but and then Coalition didn't seem to do a lot on it. The numerous productivity reports, they all go into the bottom of the drawer and nothing gets done. Whereas I think now, given the chart that some media love in Australia, which is household real disposable income per person, 10% decline there. That chart's getting a lot of publicity, and the connection between that and productivity is quite high. And so it seems, to me, it's a good sign that the government's recognising this at least. It remains to be seen whether they'll do much, but at least they have the political capital to do something.
We've got the summit in August.
We've got the summit. So we'll see what comes of that. Maybe this is not the same as Hawke and Keating, but at least they're starting to talk about it and recognise that there's a problem there, which you've got to give them credit for.
Well, I guess we better stop talking and get back to the desks and be productive. Thanks, Shane. See you next time.
Thanks, Deanna. Take care.
For more info on Shane and Deanna's podcasts and reports, head to the Insights Hub at amp.com.au.